Hello, I'm Hunsley, and welcome to Livewire Markets. As part of our Outlook series ahead of the 2024 market year, we are sitting down today with Andrew Clifford, co-CIO at Platinum Asset Management, and we're going to talk all things global equities. Andrew, it's great to see you. Thanks for joining us.
Yeah, thanks for having me.
So let's start broad. What are the characteristics that you think are important to investors when it comes to incorporating global equities into their portfolios?
Look, I think it's important investors understand how much divergence there's been in the performance of stocks, in equity markets over the last year. So we've seen this phenomenon where, a relatively small number of stocks have led the market up, but there's a huge, number of stocks that have performed very poorly. And of course, for investors, this is both the risk and the opportunity. I think the risk mainly being in those stocks that have done well this year, and the great opportunity is in, the many stocks that have been struggling. And we see this, if we look at the S&P 500, just focusing on the US market where this is the real epicenter of this phenomenon, we can look at how the S&P 500 has performed relative to an equally weighted set of those same 500 stocks. And traditionally, these things track each other pretty closely. You get a bit of a divergence here or there. This year, there's a good, I think year to date, around 10% difference, which just tells you, what's been the driver of equity markets this year. So I just think you've got to be I think there are great opportunities out there, but you also need to be careful about exactly where you go in global equities.
Yeah, well, that concentration is historic in so many ways, and the divergence, I think, is quite historic as well, is it not?
Yeah, absolutely.
Yeah. So you've already alluded to it, but what stands out to you in terms of key takeaways from 2023? And I guess how does that influence your outlook for global equities in 2024?
Yeah, I think, the big story of 2023, and I think it continues into next year most likely, has obviously been that, we've seen this historic rise in interest rates. So it's the biggest tightening cycle in several decades and the sharpest. And yet, interestingly, because of that, we're only just barely 18 months beyond the first rate hike of March last year. And, the rule of thumb historically has been 18 to 24 months to see that impact, whether you think about that in economic activity or you see it in earnings. And so now, sort of, for example, in industrial stocks globally, we're starting to see, CEOs talk down their profits or having slightly disappointing results. But we still, have to get through this period of the next 12 months. So the story of 2023 was, worrying about that, and stocks that are seen as being clearly economically sensitive have generally done poorly, and everyone's crowded into the sure bets, the growth stocks, the AI plays and so on. So I think this continues to be the story for 2024, just how big an impact are rates going to have on earnings in the markets.
Do you see central banks in the West cutting interest rates next year?
Look, I certainly think we're at the end of the rate cycle, and I don't think I think the precision people get into here, like, we've got one more rate hike to go, or we're going to get, I don't think that is helpful. I think it's worth thinking about the scenarios under which we get rate cuts. So if the US economy, the global economy remains, well, it's really about the US, because the US is the robust economy. Australia, okay. But if they stay robust, probably not a lot of more rate hikes, but not a lot of cuts. The situation that I think is the outlying possibility that people aren't thinking about is that we get a lot of rate cuts, very significant ones, but that's going to be because the economy is in a bad place. And, so when we apply that back to equities, you probably want to see a rate cut or two, but if you see a lot, I think, that's not a good scenario.
Yeah, well, it's one of those cases where too many rate cuts actually don't spark the rally. Yeah. You've already referred to this with the Magnificent Seven and AI, the great surge that seemingly very few people worked out. And I guess that's really one tail, right, of 2023. Then there's developed markets, those seven, and then there's emerging markets. Where do you see the biggest opportunity likely to come from next year out of those three categories, if you like?
If we have to put it in those categories, it's ex-US and it's emerging markets. So, you want to go to the places where the damage is already done, if you like. And, so we talk about the opportunities are in individual stocks or sectors or regions that are already experiencing their recession. And so, obviously at the top of that list is China. The fall in property sales and prices has really crushed consumer confidence in that country. And so I think what that does, though, is stock prices have had an enormous adjustment. And so, if you were to look at the equivalent of the Magnificent Seven in China from 2 years ago, it's only 2 years ago we loved Tencent and Alibaba and JD and Meituan, the food delivery company. These stocks are down 60, 70%. In some cases, their earnings are still growing, in others they've slowed down, but they're trading at extraordinary values. I can keep going through lots of different sectors, but I think China tends to take the emerging markets with them generally, with the exception of maybe India, which has been the hiding place for emerging market investors. So I think that is clearly the big opportunity out of those three sets. But as again, even if we go back to the US and Europe, there are lots of companies that are really struggling already. Again, that's where you want to be looking.
Okay, so if emerging markets are where the big opportunities are, let's take the converse. Let's take the obverse. What are the biggest risks? Where are the biggest risks for global equities next year?
So the biggest risk is clearly that deep recession in the US, that the traditional relationship with interest rates does play out, and you would expect with that that earnings to be under real pressure, and that to take not just the week 400 down, but you'd expect it to take the whole market down. And what we've seen in particular, putting aside the Magnificent Seven, but if you look at the last month or so as we've become comfortable that rates might get cut, you've actually seen a lot of the speculative stocks of 2021. Many of these are down 50, 70, 80%, but they've had big rallies. Many have no business model, they're going out of business, or maybe they've got a business model, but they're still struggling to get to profitability. And the valuations, even if they get there, are still, once again, very elevated. So I think, we have two things: just a broad recession that impacts the whole market, but also I think there are a lot of stocks out there that are still pretty expensive.
Okay, so there's a lot of stocks out there that are very expensive. Talk me through some of yours, the teams, those high conviction individual holdings that you're hoping for big things in 2024. So
we've got, as I said, let's think about industries that are already in the midst of their recession. Yep. So I'd give you TransUnion in the US. So TransUnion is one of the credit bureaus. So you apply for a loan, the lender checks out your credit record. Mortgage applications are down over 90% because of what's happened to interest rates. We know that credit card applications and car loans are weakening and will be weak. So this stock was a much loved, traded on 35 times, grew forever. Interestingly, that traditional business is only about a third of their business. Their data is used in all sorts of things, like when you apply for insurance. They're used in e-commerce. They have a big business in India. So this is a business that actually, it's had a setback in its earnings, but it now trades more like 15 times. Very high quality business. So I think whether it's absolutely a great stock for this year, but for the next 3 to 5, I think it'll be. I think it's an outstanding opportunity. I could then go to Europe, and I'd nominate Allfunds. So Allfunds is a fund platform that people invest through. It's a bit more like a Visa or MasterCard than a platform that investors would know in Australia. This is really a high quality business, but of course they earn their revenues off the value of the assets, and a large part of the value of the assets are bonds. And so there's been a historic bear market in bonds. So again, their earnings have been set back because their assets under administration are down. But again, this is a very high quality business that, once we get through that bear market, assets will start to build again. Again, it's on a mid-teens multiple and should grow at a very nice sort of teens rate for some time to come. And the last one I'd throw out is we've had all the excitement about electric vehicles in recent years. In recent times, everyone's gone a bit, recent weeks, we're all getting a bit fearful. There's the discussion that EVs are mature in markets like the US, a bit less so in Europe. But what people aren't looking at is that EVs in China are booming. And the reason they're booming is that the lead Chinese companies took a very different path on EVs. They focused on getting cars cheap rather than giving you a long range. But now they're achieving both. So there is a whole range of opportunities in China along the supply chain. Forget lithium. I mean, lithium may yet be interesting again, but it's all the people with interesting intellectual property along that supply chain, from makers of cathode materials to, electrolytes and so forth, plant and equipment makers. But look, our focus at the moment there is CATL, who's the global leader in batteries, and there's a lot of fears there that they'll be excluded from the US market, perhaps even Europe. But they've got the rest of the world. They've got a very strong position, and there's also another thing we don't focus on so much, which is energy storage with renewables, which again they are a global leader in, and perhaps politically not as sensitive. And again, here's a stock. Its business is up several-fold in the last 3-4 years. And you're buying it on 15 times. It's not going to grow quite at those historic rates anymore, but it's a pretty exciting opportunity.
Well, lithium has its fashions. And electric vehicles certainly had its fashions. All right, last one. The clincher of a question, if you like. Why should investors consider global equities above all others in 2024?
Well, I don't think they should. I think, as I said at the outset, I think they have to be careful about where in global equities they're going. And if I think really you want to be careful about your exposures to the high growth areas. Even we're already seeing a lot of the defensive areas that were very popular have started to break down and do poorly. I just think you really need to be careful about the prices you're paying. But having said that, at this point in the cycle, one of the things investors tend to get overly focused on is, now I can get 5% in my term deposit, or I can get, in private credit, I can get 8-9%. And I think the problem with that is if that's at a short duration where it's you're getting that for 12 months, I'm not sure that's valuable to you, because the very fact interest rates are there is why a lot of companies are trading cheaply. So I don't want to give an absolute answer that that's where you should be. I think you want to be there selectively, because there are risks in parts of the market.
Always providing an interesting perspective on global markets. Andrew Clifford from Platinum Asset Management, thank you very much.
Okay, thanks.
And thank you for joining us. Remember, if you want to hear and see more great interviews like that, you can go to livewiremarkets.com and our YouTube channel. Thanks for watching.